Welcome back, students. Now in this video we are going to discuss about the goodwill and its treatment. Basically, what is goodwill? Goodwill is nothing but an intangible asset. Okay, now goodwill, when I talk about goodwill, you have to understand that we have two types of goodwill. One, it is purchased goodwill. The first one is purchased goodwill. The purchased goodwill will be appearing in the balance sheet. Okay, the purchased goodwill is the one which we will be showing it in the balance sheet. And the clue word to identify whether it is a purchased goodwill or the self generated goodwill is that purchased goodwill will be mentioned as appearing in the books at. You will find the clue word appearing in the books at rupees. So if it is mentioned appearing in the books, then it is a purchased goodwill. Now, what is the accounting treatment? The accounting treatment is to write off among all the partners, including retiring partner. So write off among all the partners, including retiring partner. Got it? Including the retiring partner. This is what purchase goodwill is all about. And the journal entry to write off the goodwill is basically goodwill is an asset which will be debited. But when we are going to write off, the journal entry to write off goodwill is as follows. So the journal entry is partners, there's all partners, capital or current account will be debited. So all partners, capital or current account is debited to goodwill account. And remember, the write off will be done only in the old profit sharing ratio. So old PSR will be used to write off. Now, what is the second type of goodwill? The second type of goodwill is nothing but your self generated goodwill. The second type is self generated goodwill. Remember that the self generated goodwill won't appear in the books of account. It won't appear in our books of account. Okay, in our books of account. Then where does it appear? It will be given in the adjustment. Okay, it will be given in additional information as an adjustment. Got it? So the value will be not appearing in the books of accounts, it will be appearing as an additional information in the adjustments. Now, what is a clue word? It will be mentioned as goodwill of the firm is or was valued at. It will be mentioned that the goodwill of the firm, okay, is or was valued at, whereas appearing in the books means it is purchase goodwill, valued at means self generated goodwill. Now what we need to do with respect to this self generated goodwill, in this goodwill only we need to find out the retiring partners share of goodwill. Okay, so retiring partners share of goodwill will be found out. So retiring partners share of goodwill is calculated on firm's goodwill. This is the first step. So the goodwill of the firm is valued at is a clue word to identify it as a self-generated goodwill, and this self-generated goodwill is used to find out our retiring partner's share of goodwill. And once we found the retiring partner's share of goodwill, this is the first step, and then you have to find out the gain or sacrifice. So step 2 is to find out gain or sacrifice of continuing partner. So second step is find out the gain or sacrifice of the continuing partner. And for this, what is required to find out the gain or sacrifice? The most important item or the most required data is your NPSR. So without NPSR, the gain or sacrifice can't be found out. So for NPSR calculations, we have already discussed in our previous videos, where we have two different types: simple case or normal case, or acquired case as well as special cases. And we will have our NPSR or PSR in the pure form or in the fraction, and we have discussed how to resolve those issues. So please remember, to find out the gain or sacrifice, you must require the NPSR. Without NPSR, gain or sacrifice can't be determined. And remember the formula, okay, to find out the gaining ratio. So gaining ratio is equal to, the formula has to be used properly, right? So what is a mnemonic? You can remember the mnemonic. With that also you can find out the formula song. So if you want the gaining ratio, it is new ratio minus old ratio, right? New ratio minus your old ratio. Remember, while calculating your gaining ratio with this formula, if you get a positive value to any partner, it is declared as a gain, and if you get a negative value, it is declared as a sacrifice, right? And remember, in retirement, there are chances for one or more of the continuing partner to undergo sacrifice. So the continuing partner can undergo sacrifice or may go for a sacrifice due to the retirement of a partner. So in that case, we need to find out the sacrificing partner's share of goodwill also. That's very, very important. Okay. So the journal entry for this goodwill distribution will be gaining partners capital account, gaining partners capital or current account will be debited, followed by that to retiring partner. Okay, to retiring partners capital or current account. This is the entry which will pass for settling the retiring partner's share of goodwill. But the special note which you have to keep in your mind is that, if in case, note, if any continuing partner. If any continuing partner does sacrifice due to the retirement of a partner, then in such cases compute the sacrificing partner's share in firm's goodwill by applying his or her sacrificing ratio on the goodwill amount. Is it clear to you? So this is the one which we need to be very careful. And again, the journal entry for this particular concept is gaining partners capital account will be debited. Gaining partners capital or current account will be debited, followed by that to retiring partner capital or current account credit, followed by that to sacrificing partners capital or current account. So this will be the journal entry that we need to follow. Now here for the retiring partners capital or current account, you will be using their old PSR on the goodwill amount to find out the share of goodwill, whereas for the sacrificing partners capital or current account which we need to create it, you will use the sacrificing ratio. Is it clear to you? And for the gaining partners value, you will use his gaining ratio. So when we work out a problem, you will have a clear cut clarity on this. Any doubt up to this concept so far? To anyone, do you have any doubt? So to sum up, goodwill is basically of two types. Okay, goodwill is of two types. They are purchased goodwill and self-generated goodwill. So this is for type number one, and this is type number two. And we have said where it will appear. It will appear in the balance sheet. It will appear in the adjustment as an additional information, and the clue word to find out whether is it an additional information goodwill or balance sheet goodwill. For balance sheet goodwill, it is appearing in the books, whereas for the goodwill which is given the additional information, it will be mentioned as valued at, and the item appearing balance sheet will be written off, whereas the goodwill appearing in the additional information is used to find out the retiring partner's share of goodwill. And to find out the retiring partner's share of goodwill, we need to follow some step-by-step procedures. So the procedures is as follows. First, we need to compute the retiring partner's share of goodwill and then find out the gain or sacrifice among the continuing partner. For finding out the gain or sacrifice among the continuing partner, NPSR is very important. If the question doesn't consist of NPSR, then ensure whether it's a simple case or normal case. Based on that, find out the NPSR. Without NPSR, we can't proceed further. So definitely NPSR should be found out one in any one of the way, and thereby once you get your NPSR, find out the gain or sacrifice by substituting the formula, and then any person who gets a positive value is a gaining partner, and one who gets a negative will be a sacrificing partner. And the journal entry is as follows: gaining partners capital or current account debited to retiring partners capital or current account. Okay, so now let's move on to the problem so that you will have a clear cut idea what needs to be done. So look here, question number 13. Okay, so in the problem, if you see, it is mentioned that there are partners named as Sunil, Shahid, and David sharing profits and losses in the ratio 4:3:2. Right? So let's work out the problem. Problem number 13. So we have three partners, namely Sunil, Shahid, right? Yes, it is Sunil, Shahid, and the third partner named as David. Okay, so the three partners, Sunil, Shahid, and David, are partners sharing the profits and losses in the ratio 4 is to 3 is to 2. Just make this as a fraction. So 4 plus 3 is 7 plus 2 9. 4 by 9, 3 by 9, and 2 by 9. Okay, let's see who has got out of the business. So who has retired from the business? Shahid retires, and Goodwill is valued at. Okay, so if you just look at this concept, it is mentioned that Goodwill is being valued at rupees 72,000. Okay, so the retiring partner is Shahid. Okay, so Shahid is retiring. Okay, so Goodwill is mentioned as rupees 72,000. But please check out what Goodwill is that. It's mentioned Goodwill is valued at. So here we have mentioned if it is valued at, then it is firm's goodwill, that is called self-generated goodwill. In that we need to find out the retiring partner share of goodwill. So goodwill, it is mentioned as valued at. So that means in this 72,000, find out what is Shahid's share. So just calculating, okay, Shahid's goodwill, that is equal to rupees 72,000 into 3 by 9. So 9 eights are 72 followed by 3 zeros. So this gives me that 8,000 into 3 rupees 24,000. So that means step 1 we have found out. This is our step 1. Right? Find out the retiring partner share of goodwill. Okay. Now what is mentioned in the question? Let's work it out. Calculate the Shahid share of goodwill and pass journal entry for goodwill. Sunil and David decided to share future profits and losses in the ratio 5 is to 3. So as I mentioned you that in this type of problems, NPSR is mandatory. So NPSR is given. Okay, it is 5 is to 3. So now we need to find out who's gaining or who's sacrificing. Right? So step 2. So the problem said that NPSR is going to be as 5 is to 3 among whom? Among the partners Sunil and David. So it's quite given in the problem. So first write the formula, gaining ratio. Okay. So gaining ratio is equal to your what minus what? New minus old. Exactly. So your new ratio minus the old ratio. That means first let's calculate for Sunil. So for Sunil, the new ratio is going to be as 5 by 8 minus the old ratio happens to be 4 by 9. Now if you take the LCM for 8 and 9, it will be exactly 72. 9 8s are 72. So 8 into 9 and 5 into 9. So 5 9s are 45 minus. 9 into 8, 4 into 8. So 4 eights are 32. Now, what is the difference between these two? The difference between these two will be as 13. Exactly. 13 by 72. Okay. It's coming in positive. So that means the partner has gained. Okay. Similarly, find out to the another partner. Who's the other partner? The other partner name given over here is David. So calculate it for David. For David, it is going to be as 3 by 8 minus the old one was 2 by 9. So substitute it, you will be getting LCM 72 into 9, and 3 nines are 27 minus 9 into 8. 2 into 8 is going to be as 8 to the 16. So when you substitute it, how much you get it? So you will be getting 11 by 72. Now, what does it means? This is also the gain, right? This is a gain. Now, the amount 24,000 what we have derived will be shared by these two partners in the ratio of 13 is to 11. So the gaining ratio is 13 is to 11, and now we need to divide this 24,000 in the proportion of 13 is to 11. That means how much Sunil should pay and how much David should have to bear it. So for Sunil, it's going to be as 24,000 into 13 by 24, and over here it is 24,000 into 11 by 24. So just cancel it off, you will be getting an amount of rupees 1000. Here also amount of rupees 1000. So this shows that Sunil has to pay 13,000 rupees and partner David has to pay an amount of rupees 11,000. Just check it up. 13,000 and 11,000 are the amounts that needs to be settled to the partner. So here it is mentioned David with rupees 11,000 and Sunil with the value of rupees 13,000. So Shahid's capital is totally 24,000. So now we need to frame the journal. So what is a journal? The journal will be as gaining partner's capital will be debited. That means Sunil's capital or the current account is debited, followed by that David's capital or the current account is debited, followed by that the retiring partner to Shahid's. Okay, to Shahid's value. So what is the Shahid's value that we derived it? It was 24,000, right? So to Shahid's capital or current account. So that means partner Sunil has to pay 13,000 rupees, he has to pay 11,000 rupees, and totally 24,000 rupees has got settled to the retiring partner. So this is a very simple problem where we had only the goodwill appearing in the books and we had taken the corrective action for it. Let's see what is given in the next question. Question number 14. P, Q, R, and S were partners in a firm sharing profits in the ratio of 5 is to 3 is to 1 is to 1. Okay. On 1st January 2021, S retired from the firm. On S retirement, goodwill of the firm was valued at rupees 4,20,000. The new profit sharing ratio among the partner P, Q, and R is given as 4 is to 3 is to 3. So they asked us to show our working notes clearly and pass a journal entry for the treatment of goodwill in the books of the firm on S retirement. So here it's quite simple, but we have to work it off. Let's see what's the scenario is all about. So who are the partners? The question number is 14th question, right? So we are now going to do the 14th question. Okay, fine. In the question it was given P, Q, R, and S. There are four partners, and the profit sharing ratio between these partners are 5:3:1:1. Okay, so let me first record their profit sharing ratio. 5:3:1:1. So 5 plus 3 is 8, plus 1 9, plus 1 10. So write it in fraction: 5 by 10, 3 by 10, 1 by 10, and here 1 by 10. Now check it in the question: who is retiring from the business? It was mentioned in the question that on 1st of January 2021, yes is retiring from the business. Okay, so the retiring partner is yes. So we need to calculate it what is yes share in the firm's goodwill. Okay, so please be very careful because so what is his share of goodwill? Okay, so we need to find out the goodwill of yes. Okay, so it was said in the question that the goodwill of the firm on yes retirement was rupees 4,20,000. Right, on yes retirement, goodwill of the firm was valued at, again it is a self-generated. So 4,20,000 rupees is the firm's goodwill. Okay, so goodwill of the firm is given as rupees 4,20,000. Now what is yes share in it? Okay, so yes share of goodwill will be as follows: 4,20,000 rupees into 1 by 10. So when you cancel the common zeros, this gives you rupees 42,000 should be paid to S as a settlement of goodwill. Okay. Now, what is the new profit sharing ratio after the retirement of partner S? So PQR are going to share it 4 is to 3 is to 3. So NPSR is given for us according to this problem, the NPSR among the partners. As I said, without NPSR, the sum of these categories can be proceeded further. So NPSR between P, Q, and R is given as 4 is to 3 is to 3. So that means 4 by 10, 3 by 10, and 3 by 10. Now you need to calculate the second step. So here this is step 1. Okay, step 1 got over. Now you calculate step 2. What is step 2? Gaining ratio. Step 2 is gaining ratio. So what is gaining ratio? The formula for gaining ratio is equal to your new ratio minus your old ratio. So we need to calculate for each and every partner separately. For P, the new ratio given for us is 4 by 10 minus the old one was 5 by 10. So that means here it gives me 4 by 10 minus 5 by 10, that is minus 1 by 10. Since the bases are similar, without LCM we can do it. So minus 1 by 10. Remember, again I'm saying it, when you are using the gaining ratio formula, the one who gets in positive is gaining, the one who gets in negative is sacrificing. Now here I got in negative. This shows that partner P has sacrifice. There is sacrifice for partner P. Okay. Now calculate for partner Q. So for partner Q, the new ratio is 3 by 10 minus the old ratio happens to be same 3 by 10. That means for partner Q it is 0 out of 10. So no gain, no sacrifice done by partner Q. Now calculate for R. For R, the new ratio is 3 by 10 minus the old ratio was 1 by 10. So this shows that a positive value of 3 minus 1 is 2 by 10, which means he is gaining. Okay, partner R is gaining. Now, just recollect it as I said here in the special note, if in case any continuing partner, if you just look here, special note, if any continuing partner does sacrifice, that means undergoes sacrifice due to the retirement of a partner, in such cases we also have to compute the sacrificing partner's share in the firm's goodwill. So here if you just see, we have got sacrifice to one among the continuing partner, that is partner P. So in this case, I should derive what amount of goodwill should be paid for partner P. For that, apply that 1 by 10 on the firm's goodwill once again. So now I have to derive partner P's share. So P's share of goodwill. So for P's share of goodwill, the value is rupees 42, sorry, 4 lakh 20,000, the amount of goodwill into the sacrificing ratio. So for him also it comes to rupees 42,000. So now we need to frame the journal. The journal is gaining partners capital or current account debit. So here the gaining partner is R. So R's capital or current account will be debited, followed by that the retiring partner. So the retiring partner in this case will be S. So to S capital or current account, followed by that the sacrificing partner to P's capital or current account. Okay, so to P's capital or current account. Now fix the values. We know the value what needs to be settled to partner S and partner P. So each gets rupees 42,000, 42,000. Now to fill the value, what amount R has to settle, you have two way. One is, as you all know, that we follow the double entry system of accounting. So debits must be equal to credits. The total of debit comes to 84,000. Sorry, the total of credits comes to 84,000. That should be your debit value altogether. This is one way. The other way is, if you just look into here, I mentioned it like you have to apply the gained partner's share on the firm's goodwill to derive what amount he'll get. So in the gaining ratio. So now the gaining ratio as we have seen in this problem is 2 by 10. So just compute on the value of 42,000 into 2 by 10. So sorry, 4 lakh 20,000, okay, into 2 by 10. Cancelling comes to 42,000 into 2, it gives you an amount of rupees 84,000. So 84,000 is the amount which R has to settle. Okay, so R's share of compensation, because R is the one who's going to give the compensation, that is 84,000. Got it? So this is your journal entry. So the question have asked us very clearly to pass the journal and to show your workings clearly, right? So we have done the workings, we have shown our working notes clearly, and we have passed the necessary journal entry for the treatment of goodwill, right? So this is another pattern whereby if any of your continuing partner is gaining, then he should be debited, and if any of your continuing partner is sacrificing, then he should be in the credit. Am I making sense? Fine. Now, one more problem, because the remaining problem all belongs to the same category. The last problem which we are going to discuss now is that the problem number 18. Look here. Hammy, Pammy, and Sunny. There are three partners by name Hammy, Pammy, and Sunny. So, problem number 18. I'm just going to work it out here. Right? Hammy, Pammy, and Sunny are partners. Okay. What is the profit sharing ratio? 3 is to 2 is to 1. Okay. So 3, 2, 1. This means 3 plus 2, 5 plus 1, 6. 3 by 6, 2 by 6, and 1 by 6. It was said in the question that goodwill is appearing in the books, okay, at the value of rupees 60,000. So that means first they have said something, goodwill appearing in the books. So goodwill in the books, right? This value is given as rupees 60,000. So what goodwill is this? It is the first type of goodwill which we have discussed. Purchase goodwill that is appearing in the books. It has to be written off in the old ratio. So calculate the value that has to be written off to the partners, right? So that means the amount 60,000 should be written off to the partners. So first one it is to be for Hammy, the next one to Pammy, and the next one to Sunny. So that means 60,000 into 3 by 6, 60,000 into 2 by 6, and here 60,000 into 1 by 6. So that means it gives you 10,000 when you strike it out. So 10,000 into 3 will give you rupees 30,000. Here rupees 20,000, and over here rupees 10,000. So first, when you have found out the amount of goodwill to be written off, pass on the entry for the this journal. So the journal will be partners capital account debited. So Hammy's capital or current account will be debit. Pammy's capital or current account will be debited. Sunny's capital or current account debited, followed by that your goodwill account in the credit. So now fix the values, that is 30,000, 20,000, and 10,000, altogether 60,000. So this is the first journal which we have worked out. Now let's move on to the remaining part of the question. Pammy retires, and at the time of Pammy's retirement, goodwill is valued at. So now there is one more goodwill. What is this? Goodwill is valued at. So 84,000. And then Hanny and Sunny decided to share the future profits and losses in the ratio 2 is to 1. So as I said, NPSR is definitely given in the question. So 2 is to 1 is the NPSR. Okay, fine. So who's retiring? It was Pammy who is retiring from the business. Am I right? On the date of Pammy retires. Okay, so Pammy is retiring. Okay, just mark Pammy as retired. Okay, so it is Pammy who retires from the business. Okay, so who is going to be the continuing partner? The continuing partner is going to be as Hanny and Sunny. And what is the new profit sharing ratio? Check out the question. It is 2 is to 1. Okay, so it is 2 is to 1. NPSR 2 is to 1. Okay, now that gives you 2 by 3 and 1 by 3. When the goodwill of the firm is given in this case as rupees 84,000. Okay, so goodwill of the firm given as rupees 84,000. So in this, what's our step? First step one is your retiring partner's share. So that means Pammy's share of goodwill. You need to find out. So Pammy's share of goodwill, how you will find out? It's quite simple. The value of 84,000 into the share of Pammy 2 by 6. So now in 6 table, so 6 ones are 6, 2 carry over, 6 fours are 24. So 14,000 into 2, that gives me an amount of rupees 28,000 which has to be paid to Pammy. Now we should know who will settle this 28,000, whether the continuing partner both Hammy and Sunny or any one among these two. So find out the step 2, that is gaining ratio. So calculate the gaining ratio. So for gaining ratio, the formula is your new ratio minus your old ratio. Just a reminder not to use the shortcuts or short form NR minus OR. Please write it in the full form. Right? Don't follow this. It's just for time constraint. I'm just using it. But if you write like this, marks will be curtailed. So first let's calculate for Hanny. The new ratio is 2 by 3 minus the old ratio of Hanny, it was 3 by 6, right? So 2 by 3 minus 3 by 6. If you do this, the LCM will be as 6, 3 into 2 and 2 into 2, that means 4 minus 6 into 1 and 3 into 1. So that gives me 3. This will be as 1 by 6 positive figure, that means gain. Similarly, calculate for the second partner, that is your Sunny. So for Sunny, it's going to be as 1 by 3 minus what was his old ratio? Old ratio was 1 by 6. So 1 by 3 minus 1 by 6. Thereby, again 6 is LCM. 3 into 2 and 1 into 2, 2 minus 1. So this gives me another 1 by 6. Right? So both have got the gaining ratio only. So partner Sunny is also gaining. So the gaining ratio is between Hanny and Sunny is nothing but 1 is to 1. So now the amount which we have calculated as a settlement for Pammy is 28,000. This 28,000 will be paid by the two partner, that is who will be paying Hammy, okay, Hanny and Sunny equally. So for him it is going to be as 28,000 into 1 by 2. So this gives me rupees 14,000 as his share of amount settlement, and for Sunny the same 28,000 into 1 by 2. So that will give you an amount of rupees 14,000 to be paid from his side. Now we got the amount what they have to pay. So now pass the second journal entry. So the second journal entry will be as follows. The gaining partner, that means who are the gaining partner? Hanny. So Hanny's capital or current account is debited, followed by that Sunny's capital or current account is debited, followed by this two who's retiring from the business, it is Pami, right? So to Pami's capital or current account, right? Pami's capital or current account. Now you have to fix the values. So it is 14,000 rupees each will pay from there and to Pami. So he will be getting an amount of rupees 28,000. So these are the three different types of problems which you can expect the max to max under the category of treatment of goodwill. So we have discussed what has to be done with respect to the goodwill appearing the balance sheet that is written off. We have also discussed what treatment should be given for the additional information goodwill, to whom it will be paid. If all the continuing partners are gaining, then both the continuing partners' capital or current account will be debited and the retiring partner will be in the credit. If in case any one among the continuing partner is sacrificing, then that sacrificing partner's capital or current account will be in the credit, followed by that the gaining partner's capital or current account will be in the debit. So with this, the concept of treatment for goodwill under the topic retirement of a partner comes to an end. So please students kindly understand the concept and then work out the problems, and please share the video with all your friends who have taken the commerce group and who are in need of accountancy, and please like, comment, and please share it to as much students as possible. And if you need any further references or if you need any further guidance, don't hesitate to ping or ask. Thank you, students.